This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
To the statement of financial position and the income statement, and we're on page 5 of the course notes. Now, although you should find, hopefully, that this chapter is reasonably straightforward, we are going to look at several things, and so we'll break it up into several parts. And quite importantly in this chapter, there's a fair amount of terminology. And so when we've finished going through it, do have a look back and check you are happy with the terminology that we've used. Anyway, we mentioned the statement of financial position and income statement in the last chapter. And what we're going to do first is we're going to look at a series of transactions of a business and look at the effect of each of these transactions on the business. And as we go through, as you'll see, we'll effectively produce a statement of financial position and an income statement. Now, quite importantly, before we go through, in this chapter, if you've ever heard of debits and credits, for the moment forget them. We'll deal with that later. But for this chapter, we're not going to do any debits, credits. Again, we're going to look at a series of transactions and just look at the effect. Let's make a start. Look at page 5, paragraph 2. And you'll see there, we start with a list of various transactions. And if you read the first one with me, it says A, first of all, the owner puts $10,000 into a separate bank account for the business. And do note, this, it says above, is a sole trader. So with no limited company, one person on their own. And to start the business going, they've put $10,000 into a separate bank account. Now we're going to look at the effect of this transaction and the following ones on the business, remember. We're keeping the business as separate from the owner. And so the effect of that transaction, or two effects of that transaction, first of all, the business owns $10,000 in cash. There's $10,000 in a separate bank account. The business owns $10,000. At the same time, though, remember, it's the owner who owns the business, and so the business owes the owner $10,000. It may sound silly, but if the business were to close down immediately, we'd take the $10,000 that's in the bank, they'd pay it to the owner, and everything would be finished. But anyway, there are the two effects of that first transaction. Before we leave it, though, two bits of terminology. First of all, we said the business owns $10,000. Well, anything owned by the business is called an asset. An asset, anything owned by the business. So, they have an asset of $10,000. Secondly, though, we said the business owed the owner $10,000. Well, we call that capital. And the definition of capital, capital is anything owed to the owner. So there we are. After the first transaction, assets, cash $10,000, capital owed to the owner $10,000. Let's move on and look at the second. The next thing that happens, the business buys a shop for $2,000. So let's list again. First of all, what does the business own? They've still got cash, but because they've bought a shop and spent $2,000, the cash has fallen to $8,000. So there's the first effect of the transaction. But of course the second effect, the business now owns a shop, and the shop is worth how much? $2,000. So in total, the business still owns $10,000. There are the assets. Remember, an asset, anything owned by the business, so they're both assets. So the assets remain at 10, but of course the business still owes the owner, which remember is capital, 10,000. So there's the position after the second transaction. Two effects, note. Cash has fallen, the shop's appeared. But they've assets of 10, there's capital of 10. It's turnover. Let's do a few more and then you can do one or two. C. The business now buys goods for resale for 1,000. Now, goods for resale, maybe our shop is buying and selling CDs. Well, if we buy any CDs, again, they're goods for resale. Unlike the shop, of course. We did buy a shop, but we intend to keep it. So let's look at the effects. First of all, what does the business own? It's still got cash, but of course, although there was 8,000 before, they've just spent 1,000 buying these goods, and so the cash falls to 7,000. The second effect, we've now got these goods for resale. Well, anything we buy that we intend to sell, we call inventory. So I'm not going to write down the definition. They are summarized at the end of the chapter. But inventory is what we call goods bought for resale. We don't intend to keep them. We're hoping to sell them, obviously, and hopefully at a profit. However, we'd bought 1,000. So the two effects, cash has fallen to 7. Inventory has appeared at 1,000. We've still, of course, got the shop. The shop was 2,000. And so the total we own is 10,000. And as we've said several times, anything owned by the business is an asset. So we've assets of 10,000. But remember, we owe the owner, the capital, 10,000. Again, two effects. But there's the summary of the position of the business. Another one, D. D, the business buys more goods for resale, but this time we're buying them on credit. Now here, nothing to do again with debits, credits. All we mean is that we've bought more goods, but we haven't paid for them. We've bought them on credit, we still owe the money. We'll pay for them later. So, off we go again. First of all, what do we own? What are the assets? The cash. Well, the cash will stay at 7. Although we've bought goods, remember, we haven't yet paid for them. The inventory, though, it was 1,000. We've now bought goods for another 2,000. So the inventory has gone up to a total of 3,000. And of course, we've still got that shop, which was 2,000. So our assets now are 12,000. I won't keep writing it down, but always anything we own is an asset. And what does the business owe? Well, of course, it still owes the owner the capital of 10,000. But this time we also owe 2,000 to the person we bought the goods from. Well, that 2,000 owing we call a liability. We call it a liability when we owe money to other people. Remember, if we owe it to the owner, it's capital. Money owed to anybody else is a liability. And the person we owe it to is a payable. So we've payables of 2,000 with a liability of 2,000. And so the total owing is 12,000, which again is sensible, surely. If the business were to close down, We've got our assets of 12. We have to pay our liability of 2, which leaves us with 10. And of course that 10,000 would belong to the owner. Well, at any stage here, stop the recording if you want and have a go yourself at the others, but then come back and check. But I'll carry on with each transaction in turn. So I'll carry on with E. We now buy a car for cash. Well, I think this should be easy enough. What do we own? Well, the cash of course will fall. It was 7,000. We've paid 3,000 for the car. The cash falls to 4. A car appears. It's an asset. We own the car. The car is 3,000. We've still got inventory. How much was the inventory? 3,000. And we've still got the shop. And so our assets, 7, 10, 12,000. And as always, there have been two effects. The first effect was the cash fell by 3,000. The second effect was the car appeared at 3,000. What does the business owe? Well, of course, the capital. We still owe 10,000 to the owner. And we've still got the payables, or the liability. How much did we owe for that inventory? We were owing 2,000. We still owe 2,000. So there's the position after transaction E. Well, that was easy enough, I hope, but let's look at F. F, the business sells half the goods for 2,400 cash. So we had all that inventory. We're selling half of them for 2,400. So, what do we own? First of all, cash. How much was the cash before? It was 4,000. We've sold goods for 2,400, so the cash goes up to 6,400. That's one effect. The second effect, of course, is the inventory falls. The inventory was how much? 3,000. If we sold half of it, we've only got half left. Half of 3,000 is 1,500. We've still got the shop. I've forgotten how much the shop was. The shop was 2,000. And we've still got the car, which was 3,000. So again, one asset has increased, the cash. Another asset, the inventory, has fallen. And the total assets are now 6, 7, 10, I think 12,900. What does the business owe? Now watch the way I write this. It may seem terribly obvious, but I'm doing it for a reason. We do owe the owner, or we did owe the owner, 10,000. I'll leave a space for a moment. You'll see why in a second. But we also have that liability of 2,000. And we still haven't paid for those goods. The problem is, though, obviously it doesn't balance. That we own 12,900. If we did close down, pay 2,000, the liability, that would leave us with 10,900. And yet at the moment, we're only showing the owner as owed 10,000. Well, it should be obvious what the other 900 is, and we can check it in a moment. But the remaining 900, surely, it must be the profit we've made on that sale. That if the business has assets of 12,900, the business must owe 12,900. If 2,000 is owed to the supplier, it must mean that the rest, the remaining 10,900, must be owed to the owner. Why is the owner owed 10,900? when it was only 10,000? Well, it's because we've made a profit on that sale of goods. Now, as I say, we can check it in a moment, but we must have made a profit of 900, and that 900 must be owed to the owner. So the capital before this was 10,000, but we end up with total capital of 10,900. 10,000 originally put in, 900 profit. Now again, the profit must be 900, it must be, but very, very obviously we can check it. And how can we check? Surely that profit must be the difference between what we paid for the goods and what we sold them for. So what did we sell them for? We sold the goods for 2,400. What did we pay for them? Well, we had purchases, or the cost of sales, sorry. It was half the inventory, so if you remember it was 1,500, and therefore, since we sold them for 2,400, we must have made a profit of 900. So clearly it does check. And it must do. On the one hand, the extra 900 on this statement must be owed to the owner and must be the profit. At the same time, this little check here clearly must come to the same figure. And although I haven't said so far, I think it's probably, hopefully, already fairly obvious that what this statement is called a statement of financial position. It's showing the position of the business at one point in time. At this point in time, here are our assets, worth 12,900. Here's what we owe to other people, the liabilities, 2,000. Here's what's owed to the owner, the capital. So our statement of financial position, or often just called the balance sheet. And although we know what the profit is, it's 900, that missing figure, this statement here serves to partly to check that 900, but to also show us how we came to make 900 profit. We paid that much for the goods, we sold them for that much. Well, this statement is called our income statement. Fine. Okay, let's do a few more. That was F. If you turn over, not too many left, but let's have a go at G. Again, as I said earlier, if you're clear what's happening, by all means pause this, have a go at one or two yourself, and then switch the recording back on and check. Otherwise, work through it with me. G. We sell the remainder of the goods for 2,800 on credit. So again, although we've made the sale, because they're on credit, we've not yet received the cash. So let's list our assets first of all. What do we own? Well, keep looking back. A few minutes ago, the cash stood at 6,400. Although we've sold goods, we haven't had the cash, so the cash is still 6,400. Inventory has disappeared. We did have some inventory, but we've sold all the remaining goods, so the inventory is 0. And on this statement, we don't waste space writing 0 items. However, we've still got the shop and the car. Which way round were they? The car was 3,000, the shop was 2,000. And so one effect is, of course, the inventory's disappeared. However, the second effect is, although we haven't received any cash for those goods, the purchaser does owe us money. And so we have an asset that we're owed money. We've got a debtor or a receivable. We say we've receivables. How much do they owe us? 2,800. And so our total assets are now 7, 10, 12, I think 14,200. Who's that money owed to? Well, a bit like before, I'll leave spaces. The original capital was 10,000. We've also got from an earlier transaction a liability we owed for those goods of 2,000. And we still owe, we haven't paid. Well, whatever happens, if the business has assets of 14,200, then in total they must owe 14,200. We know 2,000 is owed to the liability, and so the remainder, what is it, the missing figure of 12,200 must be owed to the owner. Why is the owner owed 12,200 when he only started with 10,000? The difference has to be the profit. Again, we're going to check it in 1 second, but the profit must be 2,200, assuming obviously that I have added things up properly. Let's check it. The check on the profit. What did we sell? What was the cost of what we sold? Let's have a look. And here we do it in total. We don't look at each one separately. You know, I know we've now made 2 sales, but in total, how much did we sell goods for? In G, we sold for 2,800. Earlier, in F, we'd sold for 2,400. So in total, we've had sales of 5,200. What was the cost of those sales? Well, we've sold all the inventory, which originally cost us 3,000. And therefore, in total, we've made a profit of 2,200. Now again, that's the profit from 2 separate sales. But as I said earlier, we don't show each one separately. All we show is what are the total sales, what's the total cost, and therefore what's the total profit. And of course it does check, and it must check. And as in the previous one, that profit, it was the missing figure, and our statement of financial position. To make it balanced, the owner must be owed that 2,200. The income statement here, it both checks that we've got the 2,200 right, and of course it tells us how we actually made that profit. All right, back to the notes. H. We now pay 600 of the amount owing on account. What this means is, for a while now we've had a liability of 2,000. We owe money for some goods we bought earlier. Clearly we're going to have to pay it, but here instead of paying all 2,000 at once, we've chosen in H to pay $600 now. So we're paying part of the amount we're owing, presumably. The balance, the rest of it, we'll pay later. So, I hope a very quick one. Assets first of all. With cash. The cash was how much? It was 6,400. However, we've just paid out 600, so the cash will fall to 5,800. We've no inventory, but we've still got the shop. We've still got the car. The car was 3,000. The shop was 2,000. And of course we've still got receivables. There we are. The purchaser of those goods still owes us 2,800. So the total assets, 7, 10, 12, 13, 600. How much do we owe? Well, the original capital was 10,000. We've made a profit. What was it? 2,200. And of course that hasn't changed. We haven't bought any more goods, we've not sold any more goods, we just paid an amount we owed. So the profit's the same and the owners owed 12,200. But the liabilities, we were owing a total of 2,000. We've now paid 600, and so we're only owing the difference of 1,400. And of course it balances beautifully. And I don't need to do another income statement. We already know, we've already checked, the profit is 2,200. Alright, almost there. Let's do I. The business pays electricity of 200. Now watch this carefully. It's easy, but check you're happy. What happens with it? We pay electricity. So again, let's do our list. Our assets. Cash was 5,800. We've just paid 200 electricity, so the cash is only 5,600. We've still got the shop and the car. The car was 3,000. The shop was 2,000. And we've still got the receivable. The customer still owes us that 2,800. And so the total assets, 7, 10, 12, have fallen to 13,400. So one effect of that transaction is that cash has fallen. But of course, when we paid money before, when we paid money to buy the shop, or to buy the car, or to buy the goods, the cash has fallen, but the shop appeared, or the car appeared, or the goods appeared. Electricity, of course, is a bit different. We've paid out money, but we've no asset to show for it, because we've used the electricity. Anyway, we've had one effect, cash has fallen. What do we owe? The original capital was 10,000. Again, leave a space. Liabilities. How much were we owing? 1,400. And of course that hasn't changed, we haven't paid any more. Well, since the assets are 13,400, the business must owe 13,400. 1,400 we know is owed to the supplier, and so the balance, the remaining 12,000, must be owed to the owner. Why is the owner owed 12 when it was only 10 that he put in? The difference, 2,000, must be the profit. And in fact, there are our two effects. Cash fell by 200. The profit also fell by 200. But let's check it. Let's do our income statement. We already know the reason we're making profit. We sold goods. What was it? 5,200 in total. The cost of what we sold, the inventory, was 3,000. The profit was 2,200. However, in order to make that profit, we'd had to run our shop. And in order to run the shop, we'd have to pay an expense, the electricity, of 200. And so the final profit, again, it's 2,200 from what we actually sold, but we then deduct any expenses that we've had. And the expense we've had here was electricity. And if we deduct the cost of running the business, that leaves us with a profit of 2,000. So again, it does check. But also, note the layout. Although we'll go through the full layout later in this chapter, although the final profit is 2,000, it is important that we do split it. We work out, first of all, the profit on what we actually sold. The sales less the cost of sales, 2,200, and we call that the gross profit. However, as I've said, in order to make that profit, any business will have various expenses. We've only had one, electricity, but I think, obviously enough, and we'll have later, there could have been lots of other expenses to run the business. Wages of our employees and so on. Well, the final profit, we take the gross profit, we deduct any expenses, and the final 2,000 we call the net profit. So that's simply a layout problem. Hopefully, the final profit of 2,000 you are happy with, but the two effects, again, cash fell, profit fell, because we'd had that expense. Okay, only two more, so turnover. J. Well, again, I think one you can do yourself. Pause if you want, but I'll carry on. We receive half the amount that's owing to us. With receivables, we're owed 2,800. The customer decides to pay us half of it, so we'll receive 1,400. So the assets, cash will go up by 1,400. It was 5,600, so it'll go up to 7,000. The shop's still there at 2,000. The car's still there at 3,000. But finally the receivables, of course, although they did owe us 2,800, if they've now paid half of it, they now only owe us 1,400. So two effects. The cash has fallen. Beg your pardon, the cash has increased because we received money. The other effect, receivables fell. They owe us less. But the total assets, 13,400. And what does the business owe? Well, I hope clearly. The original capital was still 10. The profit is still 2,000. We haven't sold any more goods. Just because they paid us part of the amount we were owed doesn't mean we've made any more or less profit. So the profit's still 2. The owner is owed in total 12,000. And our payables or liabilities, they of course remain unchanged at 1,400. Excuse me. All right, last of all, and one final bit of terminology for the moment, K. The owner takes 1,200 from the business. Now, so far, the owners have no money at all. The owner put 10,000 in. The business has been making profits, and so the owners owed more. The owners owed 12,000. But there'll come a time, of course, when the owner wants some of that money back. Maybe this has taken 6 months. The owner's been working there. Well, the owner's going to take 1,200 from the business. It's their business. They can take what they like. Well, what are the two effects? First of all, very obviously, if the owner takes 1,200, the cash has fallen. Cash was 7. They take 1,200. The cash now will be 5,800. Now, obviously, the car and the shop haven't changed. Shop 2,000, car 3,000. And of course the receivables. The customer still owes us 1,400. And so the assets are now 8, 10, 11, 12,200. Again, one effect is that cash has fallen, but what's the other effect? The other effect, well, surely, what was the owner owed? The owner was owed the original 10,000. In addition, we know the business has made a profit of 2,200. So the owner was owed 12,200. I beg your pardon. The profit was only 2,000. Sorry. So, no, the owner was owed 12,000. Now, this transaction hasn't changed the profit. Whether the owner takes money or doesn't take money, the profit's still 2,000. But surely, if the owner takes some of that money, the owner is going to be owed less. Well, anything the owner takes out we call withdrawals. And if the owner's taken out as here 1,200, then the amount owed to the owner falls by 1,200. And the total owing to the owner at this stage is 10,800. It was 10. It went up because we've made a profit, but it reduces by anything they've taken back. So there's the total owed to the owner. Finally, the liabilities. We still owe that supplier 1,400. And there we are. It balances. The business has assets of 12,200. Out of that, 1,400 is owed to suppliers. The remainder must belong to the owner, 10,800. And finally, why again has it changed? The owner put in 10,000 originally. The reason it changed, it went up by 2 because the business made a profit. But the amount owing fell by 1,200 because the owner took out some money, the withdrawals. Alright, well there's the first bit of the chapter. Make sure obviously you're happy with it, but then come back and we'll carry on and look at the pretty layout of these statements that we've been preparing.